Hello, in this episode we'll be talking about the monetary policy. Monetary policy refers to the policy of the central bank to maintain price stability while keeping in mind the goal of growth. In India, RBI plays the role of the central bank. When we say price stability, we mean that prices should not be too low or too high. If goods and services are too expensive, it may not be affordable for customers. On the other hand, if they are priced too low, it may not be profitable for the producers to provide these goods and services. Hence, a balance is required between the two. How did the monetary policy as we see it today come into existence? In May 2016, RBI Act was amended to provide for flexible inflation targeting framework. The inflation target is set by the government in consultation with RBI once every 5 years. Current policy targets inflation at 4% in CPI terms. There is also a 2% tolerance limit above and below. Hence, RBI aims to keep the inflation between 2% to 6%. To achieve this goal, RBI shares the policy once every 2 months. Within RBI, a 6-member team forms the Monetary Policy Committee. MPC decides the policy rates required to achieve the inflation targets. RBI also publishes the Monetary Policy Report once in 6 months. This report highlights the sources of information and inflation forecasts for the next period. MPC has several tools at its disposal. It includes reserve requirements in form of CRR and SLR, policy rates in form of Repo, reverse repo, MSF, and open market operations. We will understand each one of these in detail. Let's begin with reserve requirements. A bank accepts deposits from those who have extra and use this money to provide loans to those who need it. But the depositors may come knocking any day to get their money back. Hence, the bank cannot give the entire amount of deposits as loan. There is a requirement for a reserve so that bank is able to meet the need of these depositors. RBI regulates how much reserve the bank will keep through CRR and SLR. CRR or cash reserve ratio is average daily balance that a bank has to maintain with RBI. Currently, a commercial bank must keep at least 3% of their net deposits with the central bank. SLR or statutory liquidity ratio is the amount that bank must maintain in safe and liquid assets. Currently, banks have to maintain 18% of their net deposits in likes of government securities, cash and gold. Banks lend money to public, but what happens if a bank falls short of money or if they temporarily need money to maintain reserves? In such a case, banks either borrow from interbank market or look up to the central bank. This is why RBI is often called the lender of the last resort. RBI provides overnight liquidity to banks against the collateral of government securities at a fixed interest rate known as the Repo rate. At the time of recording of this episode, the prevalent rate is 4%. Similarly, when banks have excess liquidity, RBI absorbs this excess liquidity at the reverse repo rate. The prevalent rate is 3.35%. When there is no liquidity in the interbank market, commercial banks may turn to marginal standing facility. Banks borrow from RBI by dipping into their SLR portfolio at a higher rate than repo rate. At present, this rate is 4.25%, which is 25 bips higher than the repo. Banks may also get the bills or commercial paper discounted with RBI at the bank rate. This rate is now aligned to MSF and stands at 4.25%. To manage durable liquidity, RBI may also conduct open market operations or OMO. This includes outright purchase or sale of government securities from open market. When large capital inflows lead to surplus liquidity, RBI may also use market stabilisation scheme. RBI sells short-term government securities and keeps the amount so collected in a separate government account. Now that we have an understanding of different tools at RBI's disposal, let's see how these help manage inflation. Monetary policies are of two types, expansionary policies and contractionary policies. We'll first explore expansionary policies. RBI deploys expansionary policy when inflation is low. By increasing the money supply, RBI ensures that inflation comes back up to 4% target. RBI may buy securities to infuse liquidity in the market. Second measure is to reduce the policy rates. This makes borrowing money from RBI easier. When banks can borrow cheap, they pass on this benefit to customers, making the loans more affordable. Third measure is reduction in reserves required. Lower reserve translates to higher fund availability for lending. All these measures lead to increased lending by banks, increasing the supply of money in the system. When RBI decreases the rates, the attractiveness of savings goes down and people start using that money to make purchases. As purchases happen, the demand increases. With higher demand comes inflation. Let's take the case where inflation is high and RBI wants to bring it closer to 4%. RBI deploys contractionary monetary policy in these circumstances. RBI may sell the securities to absorb liquidity from the market. Second measure is to increase the policy rates. This makes borrowing more expensive. Since the cost of banks have gone up, they are forced to increase the loan rate for customers. Third measure is to increase the reserve required. Higher reserve requirement reduces the amount available with banks. This way, the total amount of loans are reduced, reducing the money supply in economy. When interest rate goes up, people who have excess money are tempted to invest this money or deposit this money with banks, reducing the amount available for expenses. This decreases the demand for goods and services, having an adverse impact on inflation. With that, we come towards a conclusion of this video. And with this video, we also complete season 2 of financekefunde, where we discussed right from what are bonds, how bond prices are determined, how bond prices change, how credit ratings are important, and how fiscal and monetary policy impact our Indian economy. Hope you enjoyed this. Do share your feedback in form of comments and likes. And if you haven't subscribed the channel yet, please do it right away. See you in season 3. Bye.